If you're within 5 years of retirement, I need to tell you something that might shock you. You probably are sitting on over $1 million of wealth that you're completely ignoring. And because you can't see it, you're living like you're broke when you may actually be rich. My name's Bob Wolfe. I'm a certified financial planner and an IRS enrolled agent and the founder of Healthy FP, an independent advisory firm that helps retirees navigate the uncertainty of the markets, political environment, and knowing that nobody has a crystal ball. Let's look at 3 types of retirees who are positioned to win, provided that they stick to their plan. The first type is the invisible asset millionaire. This retiree looks at their 401k balance and panics, but they ignore the massive assets that aren't printed on their brokerage statement. This is the future income from their Social Security or pensions. From an institutional investing perspective, a guaranteed income stream like Social Security is actuarially identical to a massive bond portfolio. If you receive over $40,000 or $50,000 a year from Social Security and pensions, that could be equivalent to holding a $1 million bond portfolio. The question that I most often get asked is, well, how would we actually end up verifying what this is worth to us? And what I like to do is use a proxy by purchasing and looking at annuities and how they're priced for an income stream. So if you want to verify this, there's a site called immediateannuities.com. Enter your age, your monthly benefit from income streams. This tool will tell you what it would take to buy that income stream as an annuity today. Now, an insurance company needs to make some profit. So if you want to discount that amount by 10 some odd percent, you can get to a reasonable level of what that income stream might be worth today for you from investors in the third party open market. Now, what we should do is see this as a bond in our portfolio. If we add that invisible bond to our portfolio, you may very well realize that you're already heavily allocated towards safety. This allows you to take more risk with your liquid cash and to capture long-term growth because your safety floor is already largely funded. The second type is the constrained saver. And these retirees are terrified of breaking that 4% or generalized frameworks that we see all over the news, all over YouTube, and all over the internet. The idea is that you can safely spend 4% of your portfolio in the first year of retirement and adjust for inflation thereafter. But this was created based off of some of the absolute worst economic scenarios in history. And in the vast majority of historical scenarios, that rule would leave you with a massive surplus of money when you die. It is a floor, not a ceiling. And oftentimes, when I work with folks, they will target something that is a Monte Carlo chance of success. If there's anyone here who's watching this that's used a retirement calculator, you'll often find a percentage plastered across the front result page. And this can be heavily misinterpreted and something where, depending on your goals, we may very well end up not wanting to target a high probability. If we are somebody who is single, does not have children or a legacy plan and wants to have our last paycheck bounce and die with zero, well, we should be able to be willing to target a lower Monte Carlo or probability of success. I see this as the complement being the probability that we need to make spending adjustments across our life. And that is the number one thing that we can control. So whether you use a bond tent or a static allocation, you can often safely withdraw more using dynamic spending guardrails. Think of this as bowling with bumper lanes. If the market goes really well, you give yourself a raise. If the market crashes, you tighten the belt slightly. Knowing you have a plan and a strategy to handle the volatility allows you to unlock the lifestyle wealth that you were too afraid to spend. Finally, the third wealthy retiree is the retiree who understands the spending smile. Traditional planning assumes you will spend the same amount, adjusted for inflation, every year until you are 95. But real world data shows retirement spending follows a smile curve. This can be broken down during go-go years, slow-go years in your late 70s, where discretionary spending drops largely. Finally, the no-go years, if you're planning to fund a high-flying lifestyle for 30 years straight, you may very well be over-saving. So by acknowledging that your spending will likely decline based off of different goals as you age, you will realize that you may have surplus capital right now that's holding you back from pulling the trigger and entering into retirement. So let's bring this all together. You can use a bond tent to protect against the specific risk of a crash in your first decade of retirement, or you can use a static allocation with disciplined rebalancing. Both are valid, but you must choose one and you must stand by it. Don't let the media or a nervous advisor push you out of a strategy when things get tough. If you have accounted for your invisible assets like Social Security and you're using dynamic spending guardrails for your spending, you are likely far richer than you think. I've linked to some research papers below as well as valuation tools in the description. And as always, thanks for watching, and I'll see you in the next video.